Here's what I doubt you've heard of. Tax-gain harvesting. No, I didn't say that incorrectly. Not tax loss harvesting, tax-gain harvesting. This is where you intentionally sell things that go up to pay very little in taxes. Tax loss harvesting is where you intentionally sell things at a loss so that you can harvest those losses. Tax gain harvesting is where you go, I have a position, Apple stock, for example, and you bought it for $10,000. And maybe it's gone up. Maybe it's worth $20,000. You might be able to pay 0% in taxes on that $10,000. And I'm going to guess you love the idea of 0% in taxes. Who doesn't? So let's go through an example. If you're married filing jointly and your taxable income is below $89,250, you can pay 0% in taxes on those gains. So hypothetical here, you retire early, age 55, and your income is very low. In the future, let's say in 5 years, a pension begins. And let's say there's rental income in the future and Social Security and all these things, which might not be there in the future, but today. But let's use it super simple for this example. You say, Ari, I'm retired early. I loved it. You did a great job. My income is very low, and so I don't have to pay a lot in taxes. I love you. Now, no one's ever said I love you, but people have said, Ari, that's wonderful. And I'll say, hey, don't let me be the good guy this year. Okay, my dopey joke, which a lot of you will hear of, is I'm not going to save you a ton in tax in a single year. We go, all right, I think that's like kind of why I'm paying you. I go, no, you're paying me to save you the most over the next 30 years. So what we're going to do this year is we're going to intentionally pay a little bit in taxes to avoid paying a ton in the future. But we might try to pay 0% in taxes. And that's really what you all want. So here's the example. Let's assume you retire. You're 60 years old or 55, any of these. Let's say 55. You retire early and your income is very low. In fact, it's 0 because you're not working anymore. But let's just say in this hypothetical here, there's no income and you have a very healthy stock position. Okay, you bought Apple stock for $10,000 and it grew like crazy to $100,000. That's a $90,000 gain that most people go, in your head, I know I'm gonna have to pay some taxes on it, and I think it's 15%, and for most of you it will be that. Unless you retire early and have this opportunity. You could, in this hypothetical example, say, I'm gonna take that $90,000 of gains from $10,000 to $100,000 and I'm going to see how much I can pay 0% taxes on. And what was the number I told you before? It's right here once again, $89,250. That's the taxable income magic number here. So if your income is below that, you get to pay 0% taxes. So in this hypothetical here, if you have $0 of income and you have an Apple stock gain from $10,000 that went to $100,000, gain of $90,000, you get to pay 0% on $89,250 of the gains. And the other $750, that would get taxed at 15%. So hypothetical, let's assume that you're done working, but your partner's working and they make $40,000 and your taxable income, let's just say is $40,000, okay? $40,000, remember you get to pay 0% up until $89,250. So $89,250 minus $40,000 means that we have $49,250 that we could realize and pay 0% taxes on. Pretty cool. But wait, there's more. And that kind of sounds like an infomercial. But the reality is here, there's that standard deduction I talked about. So you get to take that as well. So really the standard deduction, we don't want to forget about. So that standard deduction that I talked about, that $27,700 if you're married filing jointly, that essentially gets added on to the $89,250. So you can create a ton of tax-free income. This is a really helpful strategy for a brokerage account with significant gains and you're retiring early where your income will be very low.